work of boats and ships is still important, and sailing the oceans is still dangerous because the sea is as unpredictable as ever.
Everything factors into oil. It's going to roil through the market. It's going to impact everything, and oil is also a base cost.
The real kind of problem here that I wanted to bring you on to sort out is all the different flavors of oil, the weights, the spreads.
At a base level, crude oil is what comes out of the ground. If you want to turn it into diesel, gasoline, jet fuel, all these other derivative products, you have to push it through a refinery. That refining costs money, that takes margin, and so those products are going to get squeezed faster. There's also just less supply around, and there's less refining capacity around the world than there is crude oil production capacity. All of that's going to put you in a situation where crude oil goes up 10%, diesel or gasoline goes up 12%. Diesel is also crucial because it's the backbone of pretty much all of the transport around this country on the industrial side. Any of the big 18-wheelers going by are running on diesel. If diesel prices go up, all those margins tighten, and that makes a much worse situation for a lot of global shipping.
Of course, we don't get our oil that gets turned into gasoline here. It doesn't go through the Strait of Hormuz, right? It's from here. But we're affected by global oil prices.
Yeah. The caveat is that everything's global with oil.
Everything's global with oil, right? So even though it's a local market, it's a global price, I guess you could say.
We also export most of the oil that comes out of the ground here, and then import a lot of what we're going to end up turning into gasoline through the refineries. A lot of that comes from Canada, some other markets, but a lot of the U.S. crude gets exported. So this is the whole kind of thing about calling us energy independent. We're not really energy independent because we still get a lot of our imported oil from Canada, from elsewhere, because that's heavier crude. We export lighter crude here. It's what comes out of the ground in Texas. That heavier crude is what's going to go through those refineries down along the Gulf Coast that then becomes the gasoline that we run on.
Gotcha. And the lighter crude gets made into what?
A variety of products, but some of that is, it could be jet fuel, could be a few other things. A lot of that's just market pricing. So Brent crude, up until last night, typically trades at a premium to West Texas Intermediate, our oil, because it's lighter, it's what we call sweeter or less sulfurous, and so it's much easier to refine, there's a better margin on it. Heavier sour crude, like you saw talked about with Venezuela, much more expensive, more difficult to refine.
I want to ask you to define something else for us, because I've been seeing this term a lot, shut-in, which I think of as like a hoarder who doesn't leave the house, but is also has an oil connotation that is very relevant to all the discussions we've been having, right?
I mean, it's not a bad metaphor to think about because essentially what you're saying is that if oil can't get out of the Strait of Hormuz and it's trapped in the Persian Gulf, it has nowhere to go. There's no offtake lever. And so that oil is going to start backing up in storage. Let's say I'm Iraq and I'm producing oil. I've only got X amount of storage. Once that storage fills up, if I've got nowhere to give the oil off, I've got to stop producing, or else that storage, you can't keep filling what's already full. And so you're starting to see these major companies. The big news this morning, Saudi Aramco announcing shut-ins. Iraq has now cut 60% of its national production. Kuwait has cut production.
UAE cut production.
Yes, UAE cut production. And the problem is that this is not a flip the switch, it's right back on. You have to, this is a process that takes hours to days to weeks. If these shut-ins last for a long time, that could be months to get these refineries rerunning. And so that's going to create even more tightness in a market that's already tight.
Right now, in the very, very short term, there's too much oil supply because you can't move it. Yeah. But what we're pricing in is a scenario in the future when there's not enough oil supply. And I guess I think the average person forgets that there's a physical component to the oil market. And what you're describing is essentially the theoretical futures market becoming physical like in 5 days.
Yeah, everything's physical with oil because the single most important bottleneck with oil is, can you move it around the world? Can you get it from where it's produced, which is usually not where it's consumed, to where it needs to go? This is why you see so much stress on the Nikkei, on the Kospi, because those Asian markets really depend on the oil coming out of the Gulf. And so what you see is the physical market tightening down, oil cannot get out, and so the futures prices are going to have to get up as people try to compensate for that.
Okay, so you have the problem of the oil being produced, that it's in the tanks, and they're shutting down that production, and it's going to take a while to ramp it back up. Then you have the actual destruction of the infrastructure that will take months, years to rebuild.
Well, this is how you've seen the conflict evolve. Energy infrastructure has always been kind of the red line that you don't cross because it is so destructive, and both sides know that if they strike first, the other side is going to come back triply as strong. Now that energy infrastructure is being struck, everything I'm hearing from everybody I talk to is that the lid is kind of off. All bets are off. This is only going to get worse because you've now got these countries that depend on energy revenue, getting their energy revenue targeted, and that's going to ripple out. And it's going to be, as you say, months to years to get all that repaired.
We're going to see a lot of volatility, extreme volatility. So we are now in the middle of one of the biggest crises in the energy market I have seen.
At what price do we start to see demand destruction that could then cap some of the increases?
Look, in some cases, for instance, aviation and also road transportation, you can see it at around $100 per barrel already. There is a large chunk of oil demand which is actually not that price sensitive. So even if prices reach 120, 130, 140, the demand will be there. There is one big caveat, though, which is I'm talking about the direct effect on the oil demand. There is an indirect effect which is much more powerful, which is potentially a recession. So if we see prices at 140 for maybe 3-4 months, then you can see an inflation spike, you can see interest rates increasing, and that could trigger a severe slowdown and potentially even a recession. If that is the case, then oil demand will drop even more. The risk here is one of asymmetric war. So specifically, Iran may have the ability to continuously disrupt the Strait of Hormuz via drones and via mines. If that is the case, we may be in for a long period of disruption. Not necessarily complete closure, but it's enough to severely reduce the flow of crude and natural gas, and then you have huge price spikes. Now, there are ways to redirect some of the crude, specifically from Saudi Arabia and from the UAE, but this is not enough. It's not going to be enough. Eventually, you will need for the oil markets and the energy market to completely work as normal. The Strait of Hormuz needs to be completely restored. So that is the priority number one for the entire world. I agree with you. So it's the entire world that is suffering from this situation.